I think there's going to be a lot of opportunity for infrastructure providers, people who build managed services. But the problem is those managed services are going to start to get bundled together, because right now it's like, okay, you're paying 2% for your custody, right? Or maybe it's 1%. Then you're paying 2% for networking services, 3% for your valuation. You're paying X% for this. And before you know it, annually, you're paying 10%, 11, 15% of your asset base for these services. That's not going to work. I actually think that's the death of the crypto fund model that a lot of crypto funds haven't started to realize yet, is when these services charge on an AUM basis and they're really expensive, you're going to very quickly run into a situation where people are paying more in fees to service providers than they're actually making on the fund. And so I think in a lot of cases, infrastructure providers in the short term will probably cannibalize their own market, which is where we're going to need to see more collaboration between different service providers to bundle these services, to work with institutional service providers to sort of offer this on a cost basis to really build a long-term viable business. So that was a long answer. I apologize.
I know it. Jake, go ahead.
Sorry. That was really interesting, actually, like your last point. And would you say, Meltem, that sort of motivates crypto funds even more to be like even more technical? So maybe they can do custody eventually themselves, or other services like in-house?
I would definitely say so. But I think one of the challenges is financial regulations pretty well defined in this country and in many other jurisdictions. Hey, Dan.
What's up, Dan?
Hey, guys. How's it going?
Hey, we're just finishing up talking about crypto funds. Your favorite.
Yeah, we're riffing on funds and custody and the sort of the bag of different service providers that sit between investors and the actual asset, and what that's going to look like.
Actually, I have to make a disclosure. I'm an investor in Dan's company, Picks and Shovels. So if I say flattering things, forgive me. I will try to be as unflattering as possible.
Amazing.
Sorry. So Jake, I do think a lot of funds, and one of the things I think about a lot, even for what we do, is like, where's the margin going to be if every service provider is extracting their pound of flesh, right? And I think the hard part is like, yeah, it's hard to build these services. The addressable market's really small. And I think this year we saw, hundreds of funds that are all going after the same addressable market, believing that there are, billions of dollars out there in these crypto funds, and there's all these fees they can earn. But I do think that's probably a little bit of a naive approach. I do think people are price sensitive. I do think people are cognizant of cost, especially in a market where some funds are down. I think Pantera I saw was down 72%. In that environment, I think you become very sensitive to expense ratios. And actually, I looked at starting a crypto fund, and my main reason not to, aside from the fact that I don't know how great I would be at dealing with investors and getting pitches all day. One of the big issues was the fact that the expense base was going to be over 10%, just for all the different services, accounting, et cetera. And so what we're going to start to see, I think the smaller funds are going to die or get merged into the big funds or merged together. And it's really going to be only the big funds that can afford this full stack of back office, mid office, and network infrastructure services.